You and your partner have been looking into buying a house, spending weekends driving all over to open house after open house. Then finally, you both fall in love with the same house. It has a big backyard. The neighbors are a delight. Ooh, and it's even close to a park. So you decide to put an offer on the house. But you'll need a loan to afford your dream house. If you're unsure how to approach buying a house, you're in the right place. Let me explain everything you need to know about buying a house. Welcome to the Deep Dive, an immersive audio experience from Extra where we'll go in depth on all things credit in a way you can actually understand. I'm your host, Patrick, and I'm here to help you learn the best tips and advice to build your credit. Whether you're exploring career paths or Googling what you need to apply for your apartment, most of us didn't get a crash course on credit. And credit is confusing. It's a game we all have to play, but no one teaches us the rules. That's where Extra comes in. We got you. Today's episode will be all about buying your first house. Very exciting stuff. So sit back and relax. Feel free to put your phone down and just listen or follow along with the text on screen. This is the Deep Dive. Congratulations! You're ready to buy a house. It's a big step, so let us guide you in getting ready by helping you understand how your credit score impacts your ability to buy a house. Let's start with your credit score. Your first question is probably, what is a good credit score to buy a house? Honestly, it all depends on what type of mortgage loan you're applying for. And yes, there are different kinds of homeowner loans. Here's a breakdown. All right, first up is a conventional loan. A conventional loan isn't insured by any government agency like the other loans listed here. Conventional loans follow the standards set by Fannie Mae and Freddie Mac, aka the big banks. Fannie Mae and Freddie Mac, these probably sound familiar, are shareholder-owned companies that operate under a congressional charter. Their job is to help ensure a reliable and affordable supply of mortgage funds throughout the country. Conventional loans are typically given to people with good or excellent credit scores. They also usually have an interest rate that doesn't suck and flexible payment terms like 15 or 30-year mortgage terms. You're going to need a credit score of 620 or higher when applying for this loan in order to actually take advantage of those perks we mentioned. The 620 and above crew is an elite group of credit superstars, just like you're about to be. If your score is lower than 620 right now, don't worry. There are other loans available for you. You most definitely can still qualify for a mortgage. One way is with an FHA loan. FHA stands for Federal Housing Authority, and this is one of those loans that's insured by a government agency. FHA loans are great if you don't have the best credit score or don't have a ton of money saved for your down payment. You're going to want to have a credit score of 580 or higher when applying for this loan, but can get approved with a credit score as low as 500. You'll just pay 10% interest instead of 3.5% interest with a score of 580 or above. Another way is with a VA loan. If you're a veteran qualified service member or spouse of a veteran qualified service member, then you're likely eligible for a VA loan, which, you guessed it, is also backed by a government agency. There's no mandated minimum credit score when you apply for a VA loan, but keep in mind that your mortgage lender might have a minimum credit score of their own since the loans are distributed through private lenders, even though the VA guarantees a portion of the loan. The final kind is a USDA loan. If you want to live that cottage core or off-the-grid life in a qualified rural or suburban area and have an income that's below 115% of the area's median income, you might want to consider applying for a USDA loan. You can get away with a minimum credit score of 620 when you apply for a USDA loan, but most lenders will want your score to be at least 640. Okay, one more time. Here are the ideal credit scores to have when you're applying for a mortgage loan. Conventional loan, 620. FHA loan, minimum 500, best 580. VA loan, no mandated credit score. USDA loan, minimum 620, best 640. Now that you've got a 101 in homeowner loans, here are some tips to make things happen. Tip number 1, build your credit. If your credit score is low and it takes you out of the running for any of these loans or will make you have a high interest rate, there are a few things you can do to raise it. Tip number 2, work on your debt. The people who are reviewing your mortgage loan application are looking at your credit history and want to make sure you can handle their monthly payment, in addition to everyone else you owe a monthly payment. So, if you pay down some debt, whether it's your credit cards or paying off your car, taking care of your debt demonstrates to lenders that you can be trusted with their money because you'll pay them back. Paying down or off debt also means that you can handle taking on the financial responsibility of home ownership. Plus, your credit score is going to go up. It's a win-win. Tip number 3, have a strong payment history. Your payment history is one of the most important factors when it comes to determining your credit score. It also really helps when you're trying to build your credit. So, pay your debts back on time and build a long and strong payment history. Your credit score will be on the rise in no time. Tip number 4, stick to the credit you have, not the credit you want. Don't go out and get a loan for a new car when you're also applying for a mortgage loan. Too many applications for credit at once is a surefire sign to lenders that you're living beyond your means, which, by the way, is a bad look over time. It also is going to lower your credit score, and that's the opposite of what we're trying to do here. Tip number 5, and my personal favorite, use Extra. We're the first debit card that helps you build credit responsibly by spotting you for everyday purchases, then paying ourselves back the next business day and reporting all of those payments to the credit bureaus at the end of the month as credit-worthy payments. Tip number 6, watch your debt-to-income ratio. Less debt makes you less risky to a lender, which signals to them that you'll be able to pay them back, which is really all they care about. And your debt-to-income ratio, or DTI, helps them determine how risky you are. Your DTI is the percentage of your gross monthly income that goes toward paying off debt. Great. Okay, how do I figure that out? Not to worry. To figure out your DTI, divide the total of your recurring debt, so car payments, credit card, etc., by your monthly income. Let me walk you through an example. If your debt is $1,000 a month and your monthly income is $5,000, then your DTI is 1,000 divided by 5,000, or 0.20, or 20%. You want to keep your DTI below 50%, because the lower your DTI, the better interest, or in this case, mortgage rate, you're going to get. Tip number 7, keep a steady check coming in. A little heads up, you're probably going to be asked to show proof of your income and assets, 2 years worth of proof. So whether you own your own business or work for someone else's, make sure you keep a check coming in regularly. Your interest rate will thank you. Thanks for joining us for this episode of The Deep Dive with me, Patrick. We hope you learned a thing or two. Our next episode is all about breaking down a good credit score.